The next question is the entity obliged to declare the corporate guarantee executed in favor of its associate or subsidiaries to the working capital institution? No, the corporate guarantee is totally different. The bank guarantee is totally different. Corporate guarantee, in case the corporate guarantee is issued as per the Companies Act, it is supposed to be disclosed in the financial statements that this much corporate guarantee has been given by this company to secure the credit facilities given to the other associates or subsidiary companies. That is required to be disclosed in the financial statement. But then this subject is bank guarantee subject, that is a corporate guarantee subject. Corporate guarantee subject disclosure are being regulated by Companies Act and the disclosure and the accounting standards, whereas this bank guarantee, performance bank guarantee, partial credit enhancement, trade credit, all this basically is RBI regulated policy, credit policy. Namaste, good morning. Welcome to 159th episode of AAA Weekly Webinar Series. Today, CA Ankit Goel is not able to join as he is traveling and presently not in a position even to join from that place. See, this subject today that we opted for again is a draft directions from Reserve Bank of India regarding non-fund-based credit facilities. Now, why we are taking up this issue? Primarily, our audience is insolvency professionals, bankers, students, lawyers, chartered accountants, company secretaries, and cost and management accountants, or anyone who is actually interested in stressed assets. May it be SARFAESI, may it be insolvency, or may it be the third framework which is being introduced by RBI, known as RBI-led framework for resolution of stressed assets. In our last episode, that is 158th episode, we analyzed draft directions from Reserve Bank of India regarding third framework for resolution of stressed assets, which would be RBI-led. And there is a role for insolvency professionals and insolvency professional entities. They can actually be appointed as resolution managers for a resolution of stressed assets. So they are called in that draft directions REM, resolution managers. Now, when we saw this draft directions of RBI, which was released on 9th of April 2025, and it would be finally notified or released by RBI very soon. And as per the directions, they are supposed to seek public opinion, and finally this will come with or without some modifications. This will come. Similarly, the third framework for resolution of stressed assets would also be released very soon after the public opinion is obtained by RBI. Now, when we are discussing non-fund-based credit facilities, we understand that our audience, which is the bankers, insolvency professionals, lawyers, they also need to understand what are these directions, how it is different from the earlier directions or various circulars. The non-fund-based facilities, in fact, when we talk about non-fund-based facilities, these directions are covering what the regulator says, what kind of regulations are applicable on non-fund-based facilities, what kind of credit appraisal, documentation, and risk-based approach is required, what is the applicability of Prudential norms for partial credit enhancement. This is a concept that we all need to understand. What is partial credit enhancement? This is also called non-fund-based facility. Now, the new norms for NBFCs, Urban Cooperative Bank, Central Cooperative Bank, Regional Rural Bank. These are the new norms for issuing the non-fund based facilities. Then there is also a concept of introducing the electronic guarantees or digital ecosystem. In case you recall, most of the cases where the larger fraud has taken place, maybe in the case of Nirav Modi, Mehul Choksi, Vikram Kothari, the larger frauds that has actually taken place in India are primarily because of the non-fund based facilities, which have been misused or which were being misused by some of the people who have a negative thought process about the businesses, and they actually could find the gaps in the monitoring system, gaps in the appraisal and sanctioning system. So therefore, the government has come out with these draft directions, which will become final directions very soon. The intent of the RBI in this case is to provide a comprehensive and uniform regulatory framework for non-fund based facilities, also in short called NFB. When, as an insolvency professional, as a chartered accountant, when we see a claim which comes to us, which also has a claim for non-fund based facilities like bank guarantees, letter of credit, the co-acceptance of bills, and also the partial credit enhancement, then we struggle to find out what is the invocation of the guarantee, what is the invocation of letter of credit, how the non-fund based facilities can be converted into fund based. So the existing guidelines of Reserve Bank of India regarding non-fund based facilities, in fact, are spread across numerous circulars. To my understanding, there are numerous circulars, and some of those circulars will also subsist along with these directions, but 76 of such circulars, 76 of such circulars issued since 1967. Since 1967, the circulars, which are total in number of 76, are being repealed while this direction will be notified. So those circulars, in fact, there are many circulars which are on the bank guarantees, co-acceptances of the bills, letter of credit. Then there are guidelines on partial credit enhancement, which is normally given to for enhancement of debt market. Then prohibited or restricted non-fund based activities. Then the urban cooperative bank guidelines and the other key norms. So all these circulars, different circulars, are now being consolidated and updated, and it is proposed to be repealing all those circulars. So these directions will replace 76 circulars issued between 1967 to 2024 with one codified directions. That is what the importance of these directions are. All our audience definitely would like to understand what exactly the non-fund based facilities, most of the NBFCs, most of the regional rural banks, most of the banks and cooperative banks, they must know how they can issue the letter of creditors. The customer, the obliger, must know how they can get this facility and how the invocation can be done and what are their rights after the invocation. That is all is covered in this particular draft directions by RBI dated 9th of April 2025. For the sake of beginning, we have prepared this comparative chart. These directions are applicable. These directions are applicable to all scheduled commercial banks, regional rural banks, local area banks, urban cooperative banks, state and central cooperative banks, and all India financial institutions, and NBFCs, including housing finance companies. So these directions are applicable to the entire financial service providers. The coverage of these directions are basically, these are unified and consolidated framework covering all non-fund based facilities. non-fund-based facilities comprehensively, and the facilities which actually are being covered under these directions are issuing of guarantees, letter of credit, co-acceptances of bills, partial credit enhancements, and the guarantees. And these guarantees, first of all, these particular directions are very clear that the guarantee once issued is irrevocable, cannot be revoked. It is unconditional and it is payable on demand without any kind of demur and without even specifying the claim must be specified. The claim period must be specified, and when the claim will expire, that must be set. That must be even specified in the guarantee document. Then even the exposure limits are also mentioned for NBFCs, for urban cooperative banks, for regional rural banks, and the total guarantees cannot exceed 5% of their total asset, and that is secured. That is a total guarantees. And out of this 5%, the unsecured portion cannot go below 25% of that limit. So the tenure for all these NBFCs and the urban cooperative banks and these regional rural banks and regional cooperative banks, all these NBFCs, the maximum tenure of a bank guarantee is 10 years. However, for other, like the scheduled commercial banks, uh, then the tenure can be more than 10 years in a special case, in special cases. So in all these cases, these directions are now very clearly saying that the credit appraisal is must for non-fund based facilities, matching fund based facilities. It requires detailed risk assessment, feasibility studies, viability analysis, and also it should actually, when we come to the counter guarantees, when one bank is giving, one regulated entity is giving a guarantee, and also which is the exposure is again backed by another uh, guarantee issued by another regulated entity of RBI. So there are total capping also has been guidelined. Then there is a default loan guarantee concept is also seen. The default loan guarantee and the all this is also consolidated in one master directions, which is called draft directions dated 9th of April 2025. Then the partial credit enhancement, which was in fact being governed by circulars issued in 2015, 2016, and now this is also part of these draft directions. And then there are maximum caps that can be issued for partial credit enhancement of a bond issue. Then the issue, all the circulars will be repealed. Now, these draft directions would be applicable to all regulated entities. Now, let us understand who are the regulated entities of RBI, where these draft directions would be applicable. So first of all, it will be all commercial banks. When we say all commercial banks, that includes scheduled commercial bank, regional rural banks, and local area banks. Then this is also applicable to urban cooperative banks and state cooperative banks and central cooperative banks. Then it is applicable to all India financial institutions, and then it is also applicable to non-banking financial companies, including housing finance companies, infrastructure finance companies, investment and credit companies, and microfinance institutions, and mortgage guarantee companies. So there are many other kinds of NBFCs. So we have prepared a detailed analysis of what kind of NBFCs are existing in India as per the RBI guidelines and as per the RBI categorization. So we will study all those detailed NBFCs. So in case we see the kinds of NBFCs, because that's very important for understanding these draft directions, like what are the kinds of NBFCs which are presently operating in India. One is the NBFC, which is called peer-to-peer lending. So that NBFC, basically these are a kind of Fairsend or Lendbox. So these are the software or apps developed by technology people, and they are operating online platform to facilitate loans directly between lenders and borrowers. And these loans and these assets and liabilities are not coming to their financial statements and their balance sheets, but this is still called NBFC because they are facilitating loans which would be directly disbursed by the lender to the borrower. However, they are only a facilitator. So this is called also NBFC, which is peer-to-peer lending platform. Then is the NBFC, which is a account aggregator. These NBFCs, in fact, consolidates, organizes, and shares commercial financial data across financial institutions with the customer's consent without holding or processing money. Then these are like CAMS, FinServ, FinVoo. So these are those companies who are, in fact, the data aggregator, but the RBI is also categorizing them as NBFC. Then is the CIC, which is core investment company. Core investment company are basically those NBFCs which are holding shares, bonds, debentures of group companies, not otherwise group companies. These are core investment company, but not trading or involved in financial activity directly, but must have at least 90% of the assets in investment in group companies and at least 60% in equity shares. At least 60% in equity shares. That is what called core investment company of a group. Then is the NBFC microfinance institution. So these NBFCs are providing small loans, micro loans, typically to low-income individuals or groups for self-employment or for small businesses. Like in India, we have one SKS Microfinance, Fusion Microfinance. So these are also called NBFCs. And then we have another category, which is NBFC factors. Now, NBFCs which are engaged in the business of factoring, that is buying receivables, invoices of the companies at a discount to provide them liquidity, like SBI Global Factors, CanBank Factoring. So these are all the factoring companies which are also classified or as a kind of NBFC as per RBI. Then there are mortgage guarantee companies. Now, the guarantee companies are specialized NBFCs that provide mortgage guarantee to housing finance companies and banks, covering losses if borrower defaults. And like there are companies like India Mortgage Guarantee Corporation, and there are other also there are other also guarantees like for microfinancing for MSME. There is a guarantee corporation. So those guarantee corporations are also called the NBFCs. Those guarantee corporations are also called NBFCs. And then we have infrastructure debt fund, NBFC. The infrastructure debt fund, in fact, are those funds they invest in debt securities and refinance infrastructure projects to provide long-term lending. Although we can call them as infrastructure debt finance companies, those are also categorized, classified as NBFCs as per RBI. Now, then we have the NBFC, which are infrastructure finance company. Infrastructure finance company, for example, we have L&T Infrastructure Finance, IIFL. So these are some of the companies which are, in fact, they lend at least 75% of their total assets to infrastructure sector projects like roads, airports, power plants, etc. So these are called infrastructure companies. And these directions, RBI directions dated 9th of April 2025, which are draft directions, these would be applicable to NBFCs carrying out specific activities subject to enabling provisions under the respective. So why all these classifications were required? Because in these directions, for different kind of NBFC, there are different kind of eligibilities. So therefore, we must need to understand what are these what are these categories of the NBFCs. Now, the directions, when we see that these directions are basically not do not applicable to derivative exposures of a regulated entity, and so therefore we definitely would like to see how these directions are working and how this actually will be helpful for us to understand. So first of all, we must understand some of the definitions quickly. The beneficiary, the definition which is given in this RBI draft directions, the beneficiary is means a party in whose favor the non-fund-based facility is issued by a regulated entity. So we have all seen who are the regulated entities on which this particular directions are applicable. We have seen all commercial, scheduled commercial banks, regional rural banks, state cooperative bank, central cooperative bank, urban cooperative bank, all India financial institution, and NBFCs of different kinds for different kind of non-fund based facilities. So all these collectively called regulated entities. So the beneficiary would be a person in whose favor the beneficiary NBFC facility is being issued by the regulated entity. Counter guarantee refers to a guarantee issued by a regulated entity in favor of another regulated entity in order to facilitate issuance of a guarantee by the latter. Co-acceptance of bills means the undertaking to make payment to the drawer of the bill, which can be a seller or an exporter, on due date, even if the buyer or the importer fails to make the payment on that date. Now, the co-acceptance of bills is hardly slightly different from the letter of credit. The co-acceptance of bill is slightly different from letter of credit, but then the letter of credit and this co-acceptance of bill, I mean, in case you would have seen in the case of Nirav Modi, instead of letter of credit, it was letter of comfort which was given. Letter of comfort which was given by the Indian bank to the overseas bank, and then the overseas bank, in fact, lent the money to the company, which is overseas company. So the guarantee is defined in this draft RBI directions is a contract to perform the promise or discharge the liability of a third person in a contingent case of his non-performance or default in terms of the Indian Contract Act. That's the general definition of guarantee. So the guarantees are also, in fact, divided into various parts. One could be the financial guarantee, the other could be the performance bank guarantee, other could be the revolving guarantee, another could be. So there are many kind of further subdivisions of the names of guarantee. So we need to understand what kind of guarantees are in the financial market. The guarantor refers to a party which issues the guarantee. That means the guarantor is the maybe any regulated entity would be called as guarantor. And then we have this letter of credit is an arrangement constituting a definite undertaking of issuing a regulated entity to pay the beneficiary upon occurrence of a special event. Letter of credit is on occurrence of an event or in connection with the export of specified good against the presentation of specified documents. Now, for a letter of credit, when a letter of credit is issued by the Indian importer in favor of the exporter sitting in USA, now that letter of credit says that when a set of documents would be, when the goods will be supplied and a set of documents will be submitted to the bank will make the payment. The set of documents can be that the invoice of the goods, the shipping bill, the authority to release the goods from the shipping company, all other evidences like tax issues, all these documents considered to be specified documents, and all these specified documents will be presented before the regulated entity. Then it will be considered that the letter of credit is invoked. The obliger in fact refers to a party against whose obligation, financial or otherwise, a non-fund based facility has been issued. So in case of guarantee, the obliger may be a term, may be termed as principal debtor as defined in the Indian Contract Act. Then is the performance guarantee. Performance guarantee is performance related contingency that involves irrevocable undertaking to a predetermined sum of money to a third party in the event of failure of the obliger to fulfill or perform a contractual non-financial obligation, performance bank guarantee. Now, performance bank guarantee, it can be for the full amount, it can be for the part amount. It can be for a contractor, or it can be for a person who actually have committed certain payments, cut certain performance, certain contract, and the uh, person who actually is responsible for performing, he actually is giving a bank performance bank guarantee to his customer that if I fail, then you would have the right to invoke these bank guarantees, and my bank will give you this much of money. So that is what is the performance bank guarantee. Regulated entities we have already explained. Secured portion of non-fund based facility. Now the secured portion which normally we see is the secured portion, like the wherever the uh, regulated entity issuing the non-fund based facility is having a security interest on realizable value, which can be a collateral security, which can be a primary security, which can be a margin money, which can be an FDR, which can be a cash margin having real. All these are called the margin. So this is the security. So that security, in case it is full security, then it will be considered as a full part is secured, and if it is partial, then it is partially it is secured. So that is the then it is so this is what is the secured and unsecured part of the non-fund based facility. Then once the non-fund based facility is devolved and is converted into fund based facility, then the prudential norms shall be applicable to fund names facility, and then accordingly NPA would be kind of announced. This is the account can be classified as NPA. Now the general conditions applicable to all non-fund based facilities. I would be doing it little faster because see, this is something which is a larger direction, but then we have thought about like covering in only one webinar. So we will not make a two webinar. So please kindly stay with me till the end of, because this will complete maybe quickly, but this we would be able to complete these guidelines in today's webinar. So all the regulated entities, mandatory credit policy. So all the regulated entities must incorporate explicit policies governing non-fund based facilities, and those policies would be separately for products like guarantee, letter of credit, co-acceptance of bills, and also partial credit enhancement. So they would actually have some limit and exposure gaps, credit appraisal methodology, internal control, fraud checks, monitoring mechanism, delegation of authority. But no non-fund based facility shall be issued by a regulated entity unless their credit policy contains specific enabling provisions with detailed guidelines in this regard. So that is where it is required to have policy, and that policy would be regarding the credit appraisal. It should be at par with the funded facilities. Non-fund based facilities only for existing relationship. It should not be a kind of walk-in customer asking for a bank guarantee, asking for a letter of credit facility. Either the person should have a deposit relationship or a loan relationship. That's mandatory. And also the general requirements for a regulated entity, the nature of guarantee. One, that the guarantee, once issued, it must be irrevocable, it must be unconditional, and it must be intro-convertible, like binding and enforceable once issued. So these are all the general requirements, and it should actually avoid concentration risk. Concentration risk means the aggregate limits, total exposure towards all guarantees, individual customer exposure, and the exposure risk is also very, very important. This is what it has to be prescribed in the guarantee, in the policy of each regulated entity. And if it is not the policy, then the regulated entity would not be able to give any non-fund based facility which is not provided into their credit policy. Now, the guarantee policy requirements, like the regulated entity must clearly define their credit and their guarantee policy, whether they would be issuing financial guarantee or only performance bank guarantee. And whether they would be doing this appraisals, whether it would be considered as a loan appraisal, a risk-based appraisal will also be required, risk mitigation for long-term guarantee. Now, whenever any regulated entity other than the NBFCs, because the NBFCs are not permitted to issue a bank guarantee having a tenure of more than 10 years. However, the others, other than NBFCs and other than the scheduled commercial banks, they do have, but they must identify the kind of risk mitigation, what kind of collateral, what kind of periodic reviews are required, what kind of covenants are required for a guarantee, which is actually 10 years tenure. Feasibility and capacity assessment. Capacity assessment means whenever there is a performance guarantee. Now, if a person comes to a regulated entity saying that I need a performance bank guarantee of 100 crore because I'm getting a contract for 500 crore. Now, the regulated entity, any entity is likely to issue non-fund based facility, definitely would understand the capacity of that particular borrower, whether that borrower would be able to implement a project or deliver a project of 500 crore. That's very, very important understanding about the risk while issuing non-fund based facility, because it is every banker says that the non-fund based facilities can be converted into fund based facilities overnight. If there is any invocation, if the bank guarantee or letter of credit devolve. Now, devolve means that the buyer of the goods, importer of the goods, is not able to make the money and make the payment. So therefore, it has devolved on the issuer of non-fund based. So when it devolves upon the regulated entity, it immediately gets converted into fund based, and all this has to be a very, very risky business based on the past history in India. Non-fund based is a risky business. So therefore, these draft directions by the RBI. Now, the exposure limits for guarantees, exposure limit for facility-wise or even client-wise or even sector-wise, that can be set up by the bank credit policy. Then the asset liability management, the regulated entity must periodically review the impact of outstanding guarantees, and also if there is any gap, that should be reviewed. That's what is very important as far as this basic policy is concerned. Risk implication and compliances, monitoring and governance framework, all this must be stated in the policy. Invocation, settlement and operations. The invocation, whenever the bank guarantee is invoked, it must be paid within the claim period. It must be immediately paid. I mean, these guidelines says that even if you have some issues in mind, they must be paid, and all these disputes can be taken up later. Like honor of invoked guarantee, when anyone invoking a guarantee, immediately it should be paid, and it is to ensure the credibility and the compliance. Otherwise, the RBI would be very heavy on that particular regulated entity where the bank guarantee, performance bank guarantee or LC was paid, but on invocation or on when the LC devolves, if the payment is not paid, if the payment is not made by the regulated entity, the RBI would be very tough with those regulated entities, because this is a matter of credibility of the banking system of the India. When there are a lot of people, they actually export to India. So overseas suppliers, they export to India based on that letter of credit. And in case that letter of credit devolve and the payment is not given to the foreign supplier, that means India will lose credibility. The other importers will lose the credibility of the LC or the bank guarantee. So all this is very, very important that we say that whatever guidelines that has actually been said so far by me, as per the general guidelines, that is applicable to letter of credits also, and that is applicable to the co-acceptance of trade bills. And this is then the policy. The bank's credit policy must be annually reviewed, all these LC bills, and all this is actually very important, that the bank must have a policy. Now, second important part in these directions that I could see is the regarding the provisions for issuing an e-guarantee, means digital guarantee, because it is cost effective, it actually faster turnaround, it is a better fraud mitigation, it is an improved transparency and auditability. The use of electronic guarantee, this develop a standard operating procedures that ensures minimum manual intervention, the seamless system. So the guidelines actually have given directions to all the regulated entities that in case you would be issuing e-guarantees, then there are certain standard operating procedures regarding technology compatibility, trade finance, strong internal and external audit arrangement. Then there should be complete policy and standard operating procedures. And the standard operating procedures are also defined in detail. The integration in the system should be in immediately there. The user also, there should be a kind of a system which is maker, checker, and authorizer. There can be three levels of controls. One is a maker, and the other is a checker, and the other is an authorizer. Then the control and also the various other measures that actually would be required. So this is the electronic guarantee concept, which is being issued by RBI for the purpose of issuing of bank guarantee. And the bank guarantees now, performance bank guarantees, co-acceptance of letter of acceptance, these all can be e-guarantee. All this can be e-guarantee. So I believe most of the regulated entities, banks and financial institutions, they will come up with their detailed softwares for issuing e-guarantees, e-letter of credit, etc., so that it also travels electronically. So there will not be any requirement of physical contract of guarantee. So it will be all an e-contract of guarantee. That is when the banks would be able to implement it after the draft guidelines are released as final guidelines. Now, guarantee for mobilization of fund. The RBI does not permit any regulated entity to issue a guarantee to any entity assuring redemption or repayment of funds raised by another entity, maybe via deposits or maybe issue of bonds or maybe in any form, either directly or indirectly, unless as specifically permitted under these directions. So mobilization of fund as such, which is called a financial guarantee is not permitted to be issued by any regulated entity. So that's very clear that the guarantee can be different kind of guarantee. That can be a default loan guarantee. That can be a kind of partial credit enhancement. These are all guarantees, like in case of default, that some part would be covered. But the RBI says that none of the regulated entity would be issuing a kind of a bank guarantee to take loan from others, to take deposit from others, to take cash credit from others. So that kind of financial, or even to redeem debentures, or even to redeem a deep discount bond. So all these kind of financial guarantees are not permitted. Now, there is another concept of guarantee in the draft directions. And those other kind of guarantees are, which is called default loan guarantees. Default loan guarantee, the regulated entity, in fact, in the case of digital lending, there is a possibility of default loan guarantee. And this is applicable to the arrangement between regulated entity and the lending service providers, and then arrangement between two regulated entities involved in digital lending. So the key compliances required for default loan guarantee is that this is kind of default loan guarantee, or sometimes it is called first loss default guarantee, that cannot be equal to credit substitution. It is not a credit substitution. It is only a kind of default loan guarantee. When the loan will be defaulted, then there will be some guarantee from a bank if the loan is defaulted, then the default loan guarantee must not be used as a replacement for credit appraisal, and the regulated entities must not relax underwriting standards or because the guarantee exists. Independent credit appraisal is mandatory. So this is the concept of default loan guarantee. When we talk about the issuing of counter guarantee in favor of another regulated entity, so that is only in those cases where either the guarantee amount is higher or the risk is higher, and one regulated entity is trying to kind of hedge their risk. Then even they can get a counter guarantee from any other regulated entity, because in case you probably have witnessed in the past that there are partner banks, there are associated banks. That if the guarantee is issued by DBS, or guarantee is issued by any Switzerland bank, and that guarantee can be issued while the Indian bank is giving guarantee to DBS. So that is also called counter guarantee favoring another regulated entity. So these are the counter guarantees. And then we also can see the payment of invoked guarantee. The regulated entity must honor guarantees immediately upon invocation as per the terms of the contract or the guarantee deed. Payment must be made under protest if required. First of all, the payment should be made. But in case there is any protest, then the payment must be made under protest, and then dispute can be taken up later before any competent authority. And however, the guarantee must be paid first. The complaints about non-honoring of the guarantees, that must be investigated promptly and resolved in time-bound manner. So this is the some additional conditions are also given in the RBI draft guidelines, and that is for the guarantee business, which can be done by NBFCs, urban cooperative bank, regional rural banks, the rural cooperative banks, and state cooperative bank, and the central cooperative bank. So that means the guarantees can be issued by NBFCs and all these cooperative banks. So all the NBFCs, urban cooperative bank, regional rural bank, all these can provide financial guarantees. Now, the performance guarantee can be provided by only scheduled urban commercial bank, and NBFCs in the middle and upper layer. Now, when we see that even NBFCs can issue all financial guarantees. However, the performance bank guarantee can be issued only by urban commercial bank and also NBFCs in the middle and upper layer. So at this point of time, we must understand what are the middle and upper layers of NBFCs. Middle and upper layers of the NBFCs, in fact, are defined by the RBI. There is a base layer. Now, in this base layer, what all NBFCs are covered. And in case you would see, the base layer NBFCs are cannot issue performance guarantee. The base layer NBFCs cannot issue performance guarantee, whereas financial guarantees can be issued as per the directions, because even otherwise financial guarantees are not really possible to issue. But any non-deposit taking NBFC having an asset size of below 1,000 crore. So these are the definition of base layer. Peer-to-peer lending that we have just explained, account aggregator NBFC, operative financial holding companies, and then NBFCs engaged in providing guarantee like mortgage guarantee company, NBFC, which are not systematically important and conduct niche activities. So these are the activities which are base layer. And for them, the regulatory framework is very, very lightest regulatory framework which is applicable to them. Then is the middle layer. No, the middle layer is the only first condition which is important is the middle layer NBFCs are those which has taken deposits, regardless of its size. Even if the size of the assets are 500 crore, and if they are taking deposits from public at large, then they will be considered as middle layer NBFC. And the non-deposit taking NBFCs with asset size of 1,000 crore or more, then housing finance companies, infrastructure debt fund, infrastructure finance companies, core investment companies, and standalone primary dealer. So the regulations for these companies are rather stricter. The regulations are stricter for these kind of companies. So these are strict governance, risk management, compliance requirement. But then we come to the upper layer, because see, the upper layer NBFCs are permitted to release performance bank guarantee, to issue performance bank guarantee, and similarly the middle layer also. So the NBFC specifically identified by the RBI based on the criteria such as the asset size beyond 50,000 crores is an indicative threshold, risk perception, leverage, interconnectedness, complexity, system importance, supervisory judgment of the RBI. So when we see this Bajaj Finance Limited, Shriram Finance Limited, Tata Sons Private Limited, LIC Housing Finance, these are all upper layer NBFCs. These are all upper layer NBFCs. So the bank regulations like stricter middle layer, and then the additional requirement which is applicable to core financial services solution. Then there are enhanced corporate governance is required. So these are all the classifications of the NBFCs. There is also a top layer of NBFC, which is for the time being, it is conceptual only. The NBFC as top layer NBFC has not been identified by RBI so far. And it will, in fact, in case it attracts, in case the RBI identify a company which is a top layer company, then in that case, the very, very strict regulatory mechanism would be developed for these companies which are top layer companies. Now, for all these NBFCs, which is the middle layer and the top layer, middle layer and the upper layer. The top layer is only a kind of a concept which is not yet identified, or we also call them systematically important. Systematically important is also the name which is given by RBI, but the upper layer and the lower layer. So, for example, for issue of any bank guarantee by NBFC, the NBFCs will have to consider the caps. What are the maximum cap for issuing of bank guarantee in case of outstanding guarantee? Total outstanding guarantee should be always equal to or less than 5% of the total assets. And for any unsecured guarantee, so whatever we have as 5%, 25% of that can be unsecured. So in case we take an example of the total assets of a company is 10,000 crore, so 5% is the total limit of the outstanding guarantee. So the total outstanding guarantee I can release as an NBFC is 500 crores. And then out of that 500 crore, the unsecured guarantee part should not be more than 125. So the maximum tenure for the purpose of NBFCs is 10 can be issued by. And then we can also kind of discuss something which is the cross-border bank guarantees. Cross-border bank guarantees. That also we can discuss, which is primarily for the authorized dealers of category 1. They can only handle. They can only handle the cross-border bank guarantees. Only authorized dealers of category 1. Such transactions must be compliant to FEMA and also the foreign exchange management guarantee directions issued by RBI. Irrevocable payment commitment. This is called irrevocable payment commitments. the only authorized dealer can handle it. No, let us try to understand what is irrevocable payment commitment. Irrevocable payment commitment is a written, legally binding commitment issued by an authorized dealer bank, excluding urban cooperative bank, uh, guaranteeing that it will pay a certain amount of money on behalf of a client to the stock exchange or clearing corporation without any right to cancel or withdraw the payment once triggered. Irrevocable payment commitment. It is typically used in the context of stock market transactions, particularly by foreign investors, persons resident outside India, ensuring guaranteed settlement of the purchase of permitted securities. So, in simple terms, when a foreign investor places a purchase order for shares on a stock exchange, instead of directly paying, the custodian authorized dealer bank will issue irrevocable payment commitment to the stock exchange or the settlement corporation. This is what is irrevocable payment commitment. Then the regulatory entities are prohibited from issuing any guarantee related to external commercial borrowing. No guarantee can be issued for external commercial borrowing. Then guarantees for the trade credit. Now, the trade credit guarantees can also be issued. Again, these guarantees can be issued by the authorized dealer. It is issued on behalf of the importers in favor of the overseas lenders. Now, when we say the trade credit uh, guarantee, actually, let us understand like how these trade credit guarantees are operational. One is this relates to the import transactions, trade finance. Import transaction, trade finance, and a role of authorized dealer. Banks under RBI master directions on the external commercial borrowings and trade credit. So this trade credit is extended by overseas suppliers. Some overseas suppliers may tell the importer that he will extend a credit, say, equivalent to 1 year or even more than 1 year, and that is guaranteed by a bank as a trade credit. So that is the supplier's credit. It can be a supplier's credit, it can be otherwise, and it can be up to 3 years of credit. Up to 3 years of credit. So that's also one. It's one of the non-fund-based facility. So far, we have now discussed about various kinds of non-fund-based facilities: guarantee, letter of credit, co-acceptance of bills, and then we have also discussed the trade credit guarantee for trade credit, and then we have also discussed that the irrevocable payment commitment. So all these are non-fund-based facilities. While we all call it guarantee, but there are various kinds of guarantees which actually can be issued by regulated entities. Similarly, there are guarantees which are issued on behalf of the shares and stock brokers, which they normally give it to stock exchange or to SEBI. That is also another kind of guarantee. And then there is a guarantee for export advance or an export performance, export advance guarantee, or even export performance guarantee. These are all various kinds of guarantees which are issued for even the guarantees for overseas investment on behalf of the wholly owned subsidiaries or the joint venture abroad. These are also where there are some restrictions and some kind of regulations. Coming to a very important part, which is partial credit enhancement. And partial credit enhancement, which is one that it is offered by the scheduled commercial banks. It is offered by all India financial institutions and also NBFCs. Only those NBFCs which are top, which is not yet notified by RBI, upper middle layer NBFCs can issue where the asset size is in fact more than 1,000 crore, and housing finance companies, they can issue partial credit enhancement. And the eligible recipients are corporates and the special purpose vehicles who are issuing bonds in the bond market. So the regulated entity must include detailed uh, partial credit enhancement guidelines in their credit policy. So what exactly this partial credit enhancement basically is to enhance the credit worthiness of a bond or a debt instrument issued by companies, primarily corporates. This partial credit enhancement is to develop a debt market in India. It improves the credit rating of the bond, and it actually says that it is partially guarantee, and only for the repayment, and not 100%. The only thing, the maximum it can be a 50% guarantee by a regulated entity by way of partial credit enhancement. So the partial credit enhancement is also a non-fund based facility which can be used by any company trying to issue the bonds. And the partial credit enhancement, there are regulations for partial credit enhancements, and these are being used, and this is also will be promoted as part of the efforts of the government, RBI, to promote debt market in India. So the partial credit enhancement is also a very, very important part which we can see. So there are some regulations which are some requirements of reporting. There are some requirements of disclosure. All that actually very, very detailed disclosure requirements are there. I would be able to take some questions now, and in case I can see some of the questions, and I will see the one, whether draft guidelines allow for interchangeability between non-fund based and fund based facilities. No, there is no possibility of interchangeability between the fund based and non-fund based facilities. But the bank credit policy can also have, because see, there are some possibilities of interchangeability between the non-fund based and fund based facility, but the draft directions are not really saying that it is possible. Now, what can be seen, because see, there is a requirement of uh, complete appraisal, monitoring, and the requirement for each kind of facility is totally separate. I can understand that if I get a letter of credit, and I get a usance period of 3 months or 6 months from a overseas supplier, and customer that I get, and that customer says that I would not need the letter of credit, but that customer gives me a discount which is much more than the free credit benefit. I think in that case it should be interchangeable, because in that case I am actually making payment out of my cash credit hypothecation facility, and I am reducing my facility of issuing a letter of credit. It should be interchangeable. In fact, in the past, we have many times for our clients applied for interchangeable non-fund based and fund based facilities. The next question is the entity obliged to declare the corporate guarantee executed in favor of its associate or subsidiaries to the working capital institution? No, the corporate guarantee is totally different. The bank guarantee is totally different. Corporate guarantee, in case the corporate guarantee is issued as per the Companies Act, it is supposed to be disclosed in the financial statements that this much corporate guarantee has been given by this company to secure the credit facilities given to the other associates or subsidiary companies. That is required to be disclosed in the financial statement. But then this subject is bank guarantee subject, that is a corporate guarantee subject. Corporate guarantee subject disclosure are being regulated by Companies Act and the disclosure and the accounting standards, whereas this bank guarantee, performance bank guarantee, partial credit enhancement, trade credit, all this basically is RBI regulated policy, credit policy. So these are all the questions that I had. So there is no other question, and in case anyone has a question, that can still be taken up. So, and this is what is the subject today, and I hope this would be considered as useful, because see, we have discussed various kinds of non-fund based credit facilities. It is important because various like 76 circulars is being repealed. So this is what it is. So I would say thank you very much. This is our way of learning. Thank you.